Hello folks, it's Sunday, February 22nd, and this is the weekly market analysis video from Craig, the options linebacker. What is going on in the markets? Well, I'm going to start out this week's video by looking at the differences between the NASDAQ charts versus the Dow charts. And you can see that the NASDAQ, off of the November lows to the January highs, is still only pulled back to about the 61.8% retracement of that whole rally. So it's still showing some relative strength compared to the other indices. And then on the other side of the coin, we look at the Dow, which is already plunged below its November lows and is just within a few points of coming down to the 2002 lows. And we can see why when we look at the components of the Dow, which are companies like Citicorp and Bank of America and GM, and they're all plunging to literally options prices right now. And especially with earnings season wrapping up, what the market is telling us is that it thinks that these big industrial companies, the 30 industrials in the Dow, are going to have a tougher time making a profit going forward than the more nimble technology companies. So now let's see how the overall market is doing by looking at the S&P 500. Now, the last time I talked to you about the S&P 500, the chart was in the process of crawling up this uptrend line that you can see here. But all that does in the short-term context is create what's called a bear flag. So a bear flag is when you have an initial flagpole, you have a sideways to slightly rising consolidation, and then a break underneath that trend line then brings out the next flag pattern. Now, if we look at this, the S&P's been very symmetrical lately in the way that it moves. So in other words, in October we had a 240-point move. And then in November, we had a matching 240-point echo crash. And so from the top in January, we had about a 138-point swing to the downside. So let's draw that in here. So this is about a 138-point swing. And so what I'm looking for is a matching 138-point swing on here. And that would approximately put us down right around the 740 area, which was the intraday lows of the S&P back in November. Now, it doesn't have to do that. And as we look at Friday's price action, it generated a nice hammer candlestick, which can be a one-day reversal, but unfortunately, even though it's got a nice lower shadow on there, it didn't close near the highs of the day, which is what I'd like to see if this thing is going to stick. So when we have long tails like this, I like to see closes near the high of the day on big volume. Now, we did get some big volume coming near the end of the day, but they just couldn't hold it up there. So that's a lot more bullish when you come off the bottom and close near the high of the day. So I wouldn't be surprised to see a little bit more downside and a move to meet this target down there. Now, after we do meet that target, I would expect at least a short-term bounce, but I don't think it's going to be, I don't think this double bottom that comes along here is going to necessarily be a long-term low, which is everybody's looking for. Long-term lows are usually put in after everybody has given up looking for them and things have just washed out. This to me is not a washout capitulation decline. So when we had these kinds of declines back in October, November, this was more panic. But we're not seeing that right now. This is more of just a, for lack of a better word, resignation that things just aren't good, and it's probably not a good thing to be holding long. But I don't see any kind of panic selling down here. People are just not buying anymore. They're just not selling what they have held long term. Now, one of the tools that I like to use for finding short-term bottoms is the RSI with a period of 2 on here. And when the value gets below a 2.0, which it currently is, it's down about 1. Right now, then that's a decent buy signal. However, I like to use this in conjunction with the standard RSI 14 period, and the better bottoms are put in when the RSI 14 goes below 30, and we're not there yet. We're only still at 33 here on the S&P 500. So I'm going to wait for that bottom to come in when we see the RSI 14 at about the 30 level or below. Now, we've done very well with the Iron Condors as of late because we've had some nice flat volatility. But one of the tools that I look at is the Bollinger Bands. And when the Bollinger Bands start to get very narrow like this, that indicates a Bollinger Squeeze is coming soon because stocks will expand the range and then they will contract in a range. And what we've been doing really since the end of November is contracting in this range. And so since the beginning of January, we've known that a big move is coming soon. And so therefore, since we trade iron condors or credit spreads, which to talk in the Greeks terms are short gamma positions, they don't like it when the price moves around a lot. So what we've done in the last month for the March cycle is we've dramatically lightened up our positions and are trading very, very small and waiting out this big move. So again, you can see how the bands narrowed in again and really signaled that a big move is about to come. And we've seen that big move to the downside now. Now, something else I'm seeing on this chart is the prices had been below the Bollinger Bands now for 4 straight days in a row. That's relatively rare. The last time this has happened was back during the crash in October, where we had about 5 days in a row. So because of this, I do expect that it does show that the price has gone a little too far, a little too fast, and typically it will bounce up from here. So that lines up with some of the other indicators. But again, I'm looking for one last push lower to really kick out the weak hands before we do get some type of intermediate / short-term bounce that just sets up the next leg down. Now, finishing up today, I'll talk about my Iron Condor positions. For the month of March, what I have is what's called a bear call spread up here at the 96 level on the spiders. And so this is an options trade that if the price of the spider settles under the 96 area or 960 on the S&P near the middle of March, which is expiration day, then I keep the credit that I originally collected in this trade. So everything looks very good for this trade. And on the other side of the Iron Condor, what I decided to use was the diamonds for the bottom side of the Condor, because at that time when I placed the trade, this chart was actually the flattest one out there. So this was the stronger chart about a month ago when I did place this trade. So now it's taking a little bit of heat on the downside, but still has one level of very strong support, which is the 2002 lows down here. And again, we've got a very oversold market short term. So it wouldn't surprise me to see a bounce back up, at least into this channel. You can see this channel now that the diamonds or the Dow is trading within. So a bounce up to this channel would allow me to be able to take early profits on this position and just move on to the next month. We're about a week away from starting our April positions for the Iron Condor. So really, we don't care if the market goes up, down, or sideways. We're still making money with the Iron Condor every month. So let me know if you have any questions. I'd love to hear from you. Otherwise, we'll see you soon. Thanks for watching.